Meet Marcus. He spent 32 years at the same company, corner office by year 15, six-figure salary by year 10, retirement party at 65, full house, catered, tears at the door. Now meet David. Same company, same office park, same onboarding packet on the same day in the same year. He earned exactly what Marcus earned for 3 decades. He sat 3 desks away. David is 65, and David is still working, not by choice. That is the story we need to talk about. Because David is not an exception. David is the median. The Federal Reserve's most recent survey of consumer finances found that the median retirement savings for Americans in their 60s is $87,000. Read that again, $87,000. That is not enough to cover 3 years of average retirement expenses for a retirement that is supposed to last 20 to 30 years. And here is what makes this number devastating. It is not a low-income problem. Professionals, managers, people who spent 30 years earning above the national average. Their accounts look like David's, not Marcus's. The income was never the problem. The behavior was. There are 4 specific mechanisms that drain wealth from high earners before they ever reach retirement. Most people experience all 4 simultaneously, and most people never see them coming. Mechanism 1, expenditure cascades. Your lifestyle does not stay the same when your income grows. It expands. This is not a character flaw. It is a documented behavioral pattern. Every time income increases, spending increases proportionally or faster. You get your first real salary, you upgrade the apartment, you get a promotion, you upgrade the car, you hit 6 figures, you upgrade the neighborhood, the wardrobe, the vacations, the restaurant tab, and none of it is wrong. The problem is that none of it compounds. The raise goes in, the lifestyle absorbs it. The savings jar stays flat. This is called lifestyle inflation. And the brutal part is that you feel more financially secure every time it happens. You feel like you are doing better because you are surrounded by nicer things. But your balance sheet tells a completely different story. Most people who earn 6 figures and retire broke were not reckless spenders. They were incremental spenders. Every upgrade was justified, every increase was modest. But the pattern, stretched over 30 years, consumed the wealth that was supposed to grow. That is mechanism 1. Mechanism 2, the debt normalization trap. Americans now carry an average of $6,500 in credit card debt at any given time. Not because they are irresponsible, because debt has been normalized. Buy now, pay later. 0% for 12 months, minimum payment due. These phrases restructured how an entire generation thinks about spending. The transaction feels complete at the point of purchase. The cost gets distributed across the future, and the future keeps absorbing it. The minimum payment became the strategy, not the payoff date, not the interest calculation. Just stay current. Make the minimum, move on. And while you are making minimum payments every month, interest is quietly consuming wealth you could have been building. You spend 30 years paying for a vacation you took in 2009, a couch you replaced in 2014, a phone you no longer own. Debt does not just cost money. It costs time. Every dollar going to interest is a dollar that never compounded, never worked, never grew. In over 30 years, the difference between the person who carried revolving debt and the person who did not is not thousands of dollars. It is hundreds of thousands. That is mechanism 2. Mechanism 3, the contribution floor problem. Most companies match 401 contributions up to 3 to 6% of your salary. Most employees know this. Most employees contribute exactly that amount. And most employees never touch that number again for the next 20 years. They hit the match. They stop. The match threshold becomes the contribution ceiling. The floor becomes the ceiling. Here is the problem. The minimum contribution that earns your employer's match is not the optimal contribution for your retirement. It is the minimum threshold designed to qualify you for a benefit. It was never meant to be a retirement strategy on its own. The difference between contributing 6% and contributing 12% over 30 years with compounding is not double the savings. Because of compounding, it is far more. Run the math. A 30-year-old earning $80,000 contributing 6% hits, roughly $400,000 at 65. That same person contributing 12% hits over $800,000. Same salary, same company, same investment returns. The only variable is the percentage. Most people never raise their contribution percentage. Not after promotions, not after raises. Not after the kids leave home and the expenses drop. The floor stays the floor, and the retirement account stays small. That is mechanism 3. Mechanism 4, the sequence problem. This one is the most silent and the most expensive. When you start saving, matters more than how much you save. A 25-year-old investing $200 a month for 40 years will retire with more money than a 35-year-old investing $400 a month for 30 years. Smaller contributions, larger result. Because time is the variable that everything else depends on. That is compounding, not a concept, a math fact. A dollar invested at 25 does not equal a dollar invested at 35. It has 10 additional years to produce returns on returns on returns. By the time both investors retire, that early decade is worth hundreds of thousands of dollars. And most people spend their 20s assuming they have time. You do, until you do not. The sequence problem is silent because it does not announce itself. You do not feel it while it is happening. You feel it at 62, when you run the retirement projection and realize the numbers do not work. When you realize you cannot retire at 65, or 67, or maybe at all. That is mechanism 4. Now, let's talk about what Marcus did differently. He was not smarter than David. He was not luckier. He did not inherit money. He did not get a better salary, a better employer, or a better market. He made 4 consistent decisions. Starting at 27, decision 1. He capped lifestyle upgrades at 50% of every raise. Every time his income went up, he allowed himself to upgrade, but only half of the increase. The other half went directly to savings and investments. Before he could touch it, before lifestyle had a chance to absorb it, he still took the raise. He still enjoyed it. He just did not spend all of it. He kept the other half working. Decision 2, he paid his credit card balance in full every month. Every single month. Not the minimum, not most of it, all of it. No interest, no revolving debt, no compound interest working against him. The debt normalization trap never got its hooks in. He used credit. He just refused to carry it. Decision 3, he increased his 401 contribution by 1% every year. He started at 6%. By year 6, he was at 12. By year 10, he was contributing more than most people ever will, and he never felt a dramatic shift in his take-home pay because the increases were gradual. 1% per year. That is roughly $60 to $80 a month at his income level. He did not miss it. But over 30 years, he could not have lived without it. Decision 4, he started at 27, not 37, not 47, 27. He did not wait until he felt ready. He did not wait until the debt was gone or the income was higher or the timing was better. He started with what he had when he had it. And the compounding did the rest. Those 4 decisions stacked consistently over 3 decades produce a completely different life. Not a completely different income, the same income, a different life. He did not earn more than David. He decided differently than David. 38 years ago, in small, quiet, consistent ways, every paycheck is a decision. Right now, this month's deposit, the next one. Each one is either building one life or building another. The system is the same for everyone. The market is the same. The tax code is the same. The employer match is available to everyone who qualifies. What is not the same is the decision you make with what you receive. You are either building Marcus's outcome or David's outcome. With every deposit, with every credit card statement, with every raise, you either split or spend in full. The gap between the retirements was not created at 65. It was created at 27, in small, quiet, invisible decisions that no one was watching. Start now. One decision, 1%, one paycheck at a time. If this video helped you see the system differently, subscribe, because this is just the beginning.